Ripple-backed partners just raised over $1 billion to buy XRP straight off the open market. And the implications of that are massive. Because once you realize who's behind this and what they're really doing, you'll understand why XRP might soon become one of the most strategically important assets on Earth. This is not financial advice. What's happening right now could reshape the entire landscape of global finance. We're talking about Evernorth, a brand new Ripple-connected company that just went public about its plan to accelerate institutional XRP adoption. The CEO, Ashish Birla, yes, the same Ashish who helped Ripple build on-demand liquidity into a global product, just announced they're launching Evernorth XRP, a full institutional vehicle built to fuel the XRP ecosystem. And this isn't some startup play. This is a billion-dollar capital commitment funded by Ripple, SBI Holdings, Kraken, and even XRP co-founder Chris Elson himself. And they're not just raising funds to build tools. Their official press release says it clearly. They will use the proceeds to buy XRP from the open market to establish one of the largest institutional XRP treasuries in existence. Now, if you're serious about understanding how these kinds of institutional moves turn into generational wealth events, that's exactly what's covered inside the XRP Millionaire Blueprint. It's a complete strategy package that shows how the top 1% are positioning right now, including a detailed document, infographic, and exclusive video breakdown. You can find it in the pinned comment below this video. Now, let's break down exactly what Evernorth is doing and why this might be one of the biggest power shifts we've seen since Ripple Labs itself was founded. So here's what this means. Institutions are now openly competing to accumulate XRP before supply becomes scarce. Between Ripple's own buyback initiative last week and now Evernorth's billion-dollar round, that's roughly $2 billion committed to purchasing XRP directly. And with circulating liquidity already tightening, this is about to create a massive squeeze on available supply. Ashish Birla described Evernorth as an institutional-grade platform to bridge traditional finance with XRP-based DeFi. In his words, XRP is well-positioned for adoption, and Evernorth is built to meet that moment. Translation: they're not waiting for the system to change. They're building the system around XRP right now. Here's how it's structured. Evernorth is merging with Armada Acquisition Corp., a publicly traded SPA on Nasdaq. After closing, the combined entity will trade under the ticker XRPN. This means Evernorth won't just be a Ripple affiliate working in the shadows. It'll be a publicly traded company with a direct tie to XRP infrastructure. And their investors aren't small players either. RippleWorks, SBI Holdings, Kraken, Panta Capital, and GSR, all of whom are deeply connected to global payments and digital asset liquidity. The wording of their announcement is key. The funds will preliminarily fund open market purchases of XRP to build the world's leading institutional XRP treasury. Let that sink in. They're not waiting for ETFs or derivatives. They're going straight for the asset itself. Now think about supply. XRP's total circulating supply sits around 55 billion, but roughly half of that is locked in Ripple's monthly escrow releases. Retail and long-term holders control a large portion of what's left. Exchanges only hold a few billion XRP in active float, and liquidity pools for institutional products are even smaller. So if companies start accumulating at this scale, supply pressure will skyrocket. That's exactly what we're seeing unfold. You've got Ripple's billion-dollar treasury initiative on one side, Evernorth's billion-dollar buyback fund on the other, and potentially several more institutional vehicles forming behind the scenes. When these entities start competing for liquidity, XRP's price discovery could accelerate faster than anyone expects. And this isn't just about speculation. Evernorth's own roadmap gives us insight into where this is heading. They plan to deploy capital into validator participation, operating XRP ledger validators to strengthen decentralization and network security. DeFi integration using Ripple's RLUSD stablecoin as a gateway into on-chain finance market development, injecting liquidity into tokenized asset platforms, institutional lending, and cross-border settlements. Each of those categories directly increases XRP's transactional volume and use case. And here's the wild part: every validator, every DeFi liquidity pool, and every treasury position built with XRP adds real demand to the network. That's why this matters. They're not creating speculation, they're creating utility. Now, skeptics will say this centralizes power, but if you look deeper, the opposite may be true. By involving Ripple, SBI, and multiple third party investors, the control of validator infrastructure spreads out, not consolidates. More validators mean more security and greater resilience. It's the backbone of true decentralization. But that's not even the most important part. This initiative effectively gives Ripple and its partners a public market vehicle through which they can move and deploy XRP liquidity institutionally. That means big players, banks, funds, corporates can now tap into XRP-based treasuries without needing to go through an exchange. They can settle, borrow, lend, and transact directly on the XRPPL through Evernorth. And that's where things get really interesting, because when institutional grade systems start integrating with DeFi rails, it closes the gap between the crypto world and traditional finance entirely. It's the infrastructure for a new financial standard, one that Ripple has been building toward quietly for years. Even Chris Elson, Ripple's co-founder, jumped into this one personally. He confirmed he invested 50 million XRP of his own holdings into the Evernorth fund. That's a clear signal that he sees this as a long-term institutional play, not a speculative pop. Brad Garlinghouse himself also endorsed it, saying, "We're proud to partner with Ashish and the Evernorth XRP team to advance institutional lending, liquidity provisioning, and DeFi yield opportunities for XRP." In short, Ripple is locking arms with Evernorth to industrialize XRP's liquidity. Now here's where the big picture view comes into focus. If Ripple and its ecosystem partners continue forming these institutional vehicles, each accumulating billions in XRP, we're not just watching a price setup, we're watching the foundation of a global liquidity network. This is the plumbing layer for how value will move between tokenized assets, stable coins, and real-world settlements. And yes, that's exactly the vision Ripple outlined years ago. But this time it's actually happening through corporate partnerships and publicly traded structures. This is why many analysts, including voices like Jay Claver, are calling for major price movements in the next few years. In a recent interview, Claver said that if all catalysts align, including ETF approvals, treasury integrations, and tokenized derivatives, XRP could realistically reach $10 to $50 in the near term, then potentially enter 3 or 4 digits between 2025 and 2027 as tokenization scales. Is that possible? The math says it's not crazy. The tokenization of derivatives alone represents over $1 quadrillion in notional value. Even capturing a small fraction of that through XRP-based settlement could exponentially increase demand. And if Ripple's RLUSD becomes the dominant stablecoin for DeFi liquidity, as Visa's latest report suggests, it positions XRP as the primary settlement asset for tokenized capital markets. Now, think about that in context. Ripple's partnerships span hundreds of financial institutions. G Treasury just got acquired, and Evernorth's billion-dollar buyback is live. You're looking at a network that's no longer building, it's activating. And that's exactly why people are paying attention right now. Because when the institutions start buying, before the public realizes what's happening, that's when the biggest opportunities emerge. And that's what we're seeing right now with XRP. So where does this leave XRP right now? The moment Evernorth launched its billion-dollar initiative, the market structure started to shift dramatically. It's not just about one company buying XRP, it's about the ripple effect it creates across liquidity, network adoption, and institutional positioning. Think about it. XRP's circulating supply is limited. Exchanges hold a relatively small fraction of total supply. Ripple's escrow unlocks only $1 billion per month. And retail holders are generally long-term or inactive. Now you add in multiple billion-dollar institutional buybacks, and suddenly the market begins to tighten at the edges. Ever isn't just buying for accumulation. They're building a treasury model that acts like a central liquidity hub for institutions. This treasury won't just sit idle. It will actively provide lending liquidity, collateral for DeFi protocols, and operational XRP for large-scale settlements. That means XRP is now moving into a category of utility and demand that hasn't existed at this scale before. Each XRP entering Evernorth's treasury is effectively removed from liquid trading channels, creating scarcity in real time, and the institutional implications are profound. Take the G Treasury acquisition by Ripple. Together, Ripple and G Treasury now offer 247 liquidity optimization, real-time settlement, and cross-border payment capabilities for corporates and financial institutions. This transforms XRP from a digital asset, primarily used for remittances, into a fully operational treasury and settlement currency. Corporates can now hold XRP as part of a liquidity reserve, much like they hold cash or treasuries today, but with instant settlement and access to decentralized financial infrastructure. The scale here is staggering. Last year, corporate treasuries moved roughly 145 trillion globally, even capturing a tiny fraction of that flow through XRP-based settlement networks would dwarf any prior use case the market has seen. And Evernorth is positioning itself as the vehicle that facilitates precisely this kind of adoption. Their roadmap explicitly mentions market development, participation in tokenized asset projects, and DeFi yield provisioning, meaning XRP will be used both as a collateral layer and as active settlement infrastructure. Validator participation is another critical piece. Critics often say the XRP ledger isn't decentralized enough because Ripple historically had influence over validators. Ever Setup could actually increase decentralization by adding institutional-grade validators that operate independently while strengthening the ledger's security. More validators mean higher resilience, better transaction throughput, and increased confidence for institutional participants who need predictable network performance for treasury operations. Then there's RLSD, Ripple stablecoin, that acts as a bridge into XRP-based DeFi. Visa's recent report highlighted RLSD as one of the leading stablecoins for tokenized traditional assets. Institutions are recognizing RLUSD not just for payments, but for unlocking collateral pools, real-world asset tokenization, and yield-generating opportunities on-chain. The tokenization market itself has grown from $5 billion in December 2023 to over $12.7 billion today, and projections suggest it could reach $14 trillion by 2030. This growth directly benefits XRP because RLUSD relies on XRP as the underlying settlement asset in most institutional use cases. Think of it this way: every dollar flowing into tokenized assets or stablecoin-backed lending creates a corresponding demand for XRP to settle, collateralize, or act as the backbone of the transaction. As adoption scales, XRP isn't just a speculative asset anymore. It becomes a critical piece of financial infrastructure. This is the moment where utility meets institutional scale, which is historically when markets start pricing in real value, rather than short-term sentiment. Now layer in the public vehicle aspect. Ever being listed via SPA on Nasdaq under ticker XRP means that institutions can participate in XRP infrastructure without having to buy XRP on exchanges themselves. The Treasury acts as a proxy, a bridge between public capital markets and on-chain liquidity. That's a massive step forward because it reduces friction for corporate adoption. Companies can gain exposure to XRP-based treasury strategies, yield, and collateralization without directly holding volatile assets themselves. It's an integration of traditional finance systems with digital native protocols, and it's happening now. Let's revisit supply dynamics because this is where the market mechanics get particularly interesting. XRP's total supply is roughly 100 billion tokens with about 55 billion in circulation, but only a portion of that is truly liquid. Ripple's monthly escrow unlocks about 1 billion XRP. Retail holders often keep coins locked in wallets for years, and exchanges have limited liquidity. Now imagine multiple institutional treasuries, each with billions of dollars, actively buying XRP and locking it in for operational use. Suddenly, the Supply available for speculative trading shrinks dramatically. Price discovery will begin to reflect structural scarcity, not just market sentiment, and that scarcity is compounded by adoption. XRP isn't just being accumulated, it's also being deployed as collateral and liquidity in DeFi protocols, tokenized asset markets, and real world asset tokenization. Every time XRP is used in this way, it's temporarily removed from active circulation. The combination of institutional accumulation and operational usage effectively turns XRP into a dual-purpose asset: treasury reserve plus transactional infrastructure. This is exactly what Ripple has been building toward with RLUSD integration, DeFi adoption, and treasury partnerships. By connecting stablecoins, corporate treasuries, and XRP, they've created a network effect that scales both liquidity and adoption simultaneously. The more corporate and institutional participants join, the more XRP is locked in operational use, and the stronger the network becomes. Now, consider the macro picture. Institutional adoption of digital assets is no longer theoretical. It's happening across tokenized government securities, tokenized real estate, and corporate debt. Franklin Templeton, BlackRock, and other traditional finance leaders are now actively tokenizing billions in assets. The XRP ledger combined with RLUSD provides a stable, fast, and scalable settlement layer for these tokenized assets. Evernorth's treasury model directly connects this demand to XRP, meaning each institutional participant becomes a driver of on-chain activity and scarcity simultaneously. The DeFi layer also matters. While XRP is not Ethereum, it's now supporting liquidity provisioning, yield opportunities, and decentralized lending at a scale sufficient to attract institutional investors. RLUSD acts as the on-ramp, and XRP serves as the settlement and collateral backbone. Evernorth's participation ensures that these protocols have reliable liquidity, which increases confidence among other institutions looking to adopt XRP-based financial products. And then there's the scarcity multiplier. Every time XRP is removed from active exchange liquidity, whether through Evernorth accumulation, treasury allocation, or operational use in DeFi, the remaining supply becomes more valuable. Price formation is no longer just speculative, it's structural. Supply pressure combined with growing adoption and utility means XRP is positioned for an entirely different market dynamic. Let's also consider the geopolitical angle. Ripple has been quietly working with multiple international partners, including SBI Holdings and European financial institutions, to expand XRP adoption in capital markets. This is not just a US-centric story, it's global. By providing tools for real-time settlement, treasury management, and tokenized asset interoperability, XRP positions itself as a global bridge currency for financial institutions. Finally, we can't overlook the network effects. Every new institutional treasury, validator, and tokenized asset project that integrates XRP strengthens the ecosystem. The combination of scarcity, liquidity, and operational utility creates a feedback loop. More adoption, more locked XRP, higher network reliability, more institutional interest. This loop is exactly the kind of systemic infrastructure shift that transforms an asset from a speculative token into a foundational financial instrument. When we connect the dots, Evernorth Treasury, billion-dollar buybacks, G-Treasury integration, RLUSD adoption, DeFi liquidity provisioning, tokenized real-world assets, and global institutional adoption, it paints a very clear picture. XRP is no longer just a digital currency. It's evolving into a core infrastructure asset for both digital finance and traditional corporate treasuries. The next phase is straightforward. Expect additional institutional vehicles, public traded specs, and treasury programs to continue rolling out over the next 12-24 months. Each one adds liquidity, adoption, and scarcity pressure. The stage is set for a systemic market dynamic that hasn't existed for any other digital asset at this scale. And that's exactly why every movement by Ripple and its ecosystem partners, from Evernorth to RLUSD adoption to G-Treasury integration, matters. It's not just news. It's a structural shift in how capital flows, both on-chain and in the real world. By now, it's clear that XRP is no longer just a digital currency. It's becoming a cornerstone for institutional finance, DeFi, and tokenized asset infrastructure. After Evernorth's billion-dollar treasury initiative, the G-Treasury integration and RLOST adoption, the next phase is about how these developments translate into real-world value and potential pricing for XRP. Let's start with the fundamentals. Institutional adoption creates structural demand. Every XRP held in Evernorth's treasury, every token locked as collateral in DeFi, and every XRP used for settlement via G-Treasury reduces the circulating supply accessible to retail traders. That's not speculation. That's scarcity in motion. And scarcity combined with adoption is a multiplier effect on value now layer in tokenization. Traditional assets, government bonds, corporate debt, real estate, derivatives are moving on-chain at an accelerating pace. The tokenized asset market has already grown from $5 billion in late 2023 to over $12 billion today. Projections suggest it could reach 1 to 4 trillion by 2030. Conservatively, every tokenized asset that settles through XRP-based systems adds demand for the underlying asset. When you combine billions of dollars in institutional treasury allocations with trillions in tokenized settlements, you create a scenario where XRP isn't just a crypto asset, it's a global settlement currency. The implications for price are enormous. Analysts and insiders, including Jay Claver, have projected XRP moving to $10-50 in the near term, depending on catalysts like ETF approvals and corporate treasury adoption. Looking further, as tokenized derivatives, real estate, and other real-world assets increasingly rely on XRP, the asset could enter 3 or 4-digit territory between 2025 and 2027. This is not hype. It's a logical extrapolation of adoption, scarcity, and network utility combined. RLUSD's role cannot be overstated. As Ripple's stablecoin bridging traditional finance with XRP, it's gaining traction among corporate treasuries, tokenized asset platforms, and DeFi protocols. Visa highlighted RLUSD's utility in tokenized collateral pools, and major financial players are integrating it into their operational models. This stablecoin adoption acts as a multiplier for XRP demand. Every RLUSD transaction or collateral position requires XRP to settle or facilitate liquidity. This is where things get even more interesting. Tokenized derivatives and real-world assets on XRP create massive on-chain liquidity pools. Each new asset tokenized increases demand for collateral and settlement infrastructure. The more assets rely on XRP, the stronger the network effect, and the more institutions will feel compelled to participate. At that point, XRP transitions from a speculative crypto to critical financial infrastructure. Now consider what that means for adoption curves. XRP is no longer dependent on retail hype or short-term market cycles. Its value proposition is increasingly driven by real utility, scarcity, and institutional integration. When Evernorth and similar treasury vehicles continue to accumulate XRP, they are not just creating buying pressure, they are shaping the network for long-term adoption. Even at the macro level, Ripple's ecosystem strategy positions XRP as a bridge currency across borders and asset classes. The combination of Evernorth treasuries, RLUSD adoption, tokenized real-world assets, and corporate treasury integration represents a network infrastructure that few other digital assets can match. It's a complete ecosystem, scarcity, utility, and adoption all working together. And this is where price projections start to make sense. As adoption scales, scarcity tightens, and network utility expands, XRP can realistically move into multi-digit territory. Analysts who project $101,000 per XRP over the next 5 years are not just guessing. They're calculating based on circulating supply, institutional accumulation, and real-world adoption of the XRP ledger. Beyond that, if tokenization and DeFi integration continue to accelerate, 5-digit pricing by 2030 is within the realm of possibility. Every trillion in tokenized assets or institutional treasury flow adds incremental demand for XRP, creating a compounding effect on price. This isn't science fiction, it's network dynamics and supply demand fundamentals applied to a digital asset that's building real world utility at scale. XRP is now operating as a settlement layer, a collateral layer, and a liquidity hub all simultaneously. Each institutional partnership, treasury initiative, or validated deployment strengthens these fundamentals, and the adoption cycle doesn't stop with finance. As tokenized assets proliferate across industries from real estate to derivatives to commodities, XRP becomes the universal settlement protocol for institutional and corporate operations. Each integration expands its utility and makes the network more indispensable. That's why analysts are increasingly bullish on XRP's long-term potential. The feedback loop is clear: institutional buybacks reduce supply, operational deployment increases utility, and tokenized asset adoption strengthens network effects. The combination of scarcity, adoption, and utility creates a self-reinforcing cycle that is rarely seen in traditional markets. But it's exactly what XRP is experiencing. By this stage, XRP isn't just a crypto asset anymore. It's an institutional infrastructure asset, a global liquidity tool, and a core component of tokenized finance. Investors and institutions recognizing this early are positioning themselves strategically for the next wave of adoption and market dynamics. And for those who want to understand exactly how top-tier participants are positioning for this, that's where the opportunity lies. If you're serious about capturing this next phase of XRP adoption, we created the XRP Millionaire Blueprint. It's a complete high-level guide that includes a detailed document, infographic, and exclusive video walkthrough showing how the top 1% of investors are positioning themselves for this unprecedented structural shift to create generational wealth opportunities. You'll get a roadmap to see the same moves the largest players are making. It's in the pinned comment below this.